Before anything else, a date stamp, because this matters more for this video than almost any other video on this channel. Every number in this video, share prices, dividend yields, payout ratios, recent stock performance, is accurate as of mid-June 2026, sourced directly from public financial data providers and company investor relations releases. By the time you are watching this, some of these numbers will have moved. Dividends get raised. Share prices go up and down every single trading day. That is not a flaw in this video. It is the nature of discussing individual stocks rather than a mechanism or a tax rule. And it is exactly why every single number in this video comes with its source and date on screen, and why the closing segment tells you exactly how to check whether these numbers still hold up by the time you watch this. With that said, here is the actual question worth answering. Most best dividend stocks content stops at yield. Which stock pays the biggest percentage? That is an incomplete and sometimes actively misleading way to evaluate a dividend stock, because a high yield earned on a stock that is also losing capital value can leave you with a worse total return than a lower-yielding stock that is also appreciating in price. This video covers 5 well-known, widely held Canadian dividend payers, spanning banking, energy infrastructure, utilities, and rail, with the real, sourced numbers for both halves of the equation: what they pay you in cash today, and what has actually happened to their share price. Stock number 1. Royal Bank of Canada. What it is: Royal Bank of Canada is Canada's largest bank by market capitalization, generating revenue across personal and commercial banking, wealth management, capital markets, and insurance. The current dividend picture as of mid-June 2026. RY's trailing 12-month dividend yield sits at approximately 2.3% to 2.6%, depending on the exact source and measurement date. Note that 2 reputable data providers cited slightly different figures in the same week: 2.30% from one source dated June 19, 2026, versus 2.64% from another dated slightly earlier, which is itself a useful real-world reminder that the yield is never a single fixed number even on the same day, since it depends on the exact closing price used and whether trailing or forward dividends are applied. RY pays quarterly, with its most recent quarterly payment at $1.20 per share after a dividend increase. Dividend growth track record. RY's average dividend per share growth rate over the past 3 years has run at approximately 6.27% to 8.42% annually, depending on the measurement window cited, with one source showing 14.71% growth over the most recent single year specifically, a notably strong recent increase. RY's dividend payout ratio. The percentage of net income paid out as dividends sits at approximately 41% to 43%, based on the bank's own most recent financial disclosures, a payout level generally considered conservative and sustainable for a major bank, leaving meaningful room for continued increases. Why this matters for total return, not just yield. RY's relatively modest current yield compared to some other names on this list reflects in part a strong share price. The lower the yield on an unchanged dividend, the higher the price has run. RY's return on equity has been climbing, reported at 17.2% to 17.6% in recent quarters, up from 16.3% for the full prior fiscal year, a sign of improving underlying profitability that has historically supported both share price appreciation and continued dividend growth over time. The honest risk to watch. Canadian bank earnings are sensitive to credit conditions and loan loss provisions, which can rise during economic slowdowns, and bank share prices, including RY's, can be meaningfully affected by interest rate expectations and broader financial sector sentiment. Stock number 2. Enbridge. What it is? Enbridge is one of North America's largest energy infrastructure companies, operating liquids pipelines, gas transmission, and gas distribution and storage assets, with approximately 80% of its EBITDA regulated or contractually backed and tied to inflation, according to the company's own investor materials. The current dividend picture, as of mid-June 2026, Enbridge's dividend yield is the highest on this list by a meaningful margin, cited at approximately 5.0% to 5.3% across multiple sources in the days around mid-June 2026, 5.31% as of late April, 5.12% as of June 16th, and 5.03% to 5.05% from 2 other sources in the same general window. Enbridge pays quarterly, with the most recent quarterly dividend at 97 cents per share, $3.88 annualized. Dividend growth track record: Enbridge announced its 31st consecutive annual dividend increase in early 2026, raising the dividend by 3% effective March 1st, 2026, one of the longest active dividend growth streaks among major North American energy infrastructure companies, a genuinely notable, well-documented track record. Here is the answer to the open loop from the hook. Enbridge's dividend payout ratio. One source reports Enbridge's payout ratio at 122.16%, meaning, on a standard earnings-based measure, the company is paying out more in dividends than it reported in net income over the trailing 12 months, with an even higher cash payout ratio figure of 278.23% cited by the same source. This figure alone, viewed in isolation, would normally be considered dangerously high, in that same source's own words. The important context: pipeline companies like Enbridge generate large non-cash depreciation and amortization charges that reduce reported accounting net income without representing an actual cash shortfall, which is why analysts more commonly evaluate pipeline dividend sustainability using distributable cash flow, DCF, rather than net income. Using that measure, Enbridge's own 2026 guidance reaffirms full-year DCF per share of $5.70 to $6.10, comfortably covering the $3.88 annualized dividend on that specific basis. The honest takeaway: the net income-based payout ratio looks alarming in isolation, but the company's own preferred cash flow metric tells a meaningfully different, more reassuring story. And a careful viewer should understand both numbers rather than relying on either alone. Capital appreciation: Enbridge shares have shown a constructive technical pattern in recent trading, with one analysis in May 2026 citing the stock near $53 to $56 USD equivalent pricing, and price targets in the $54 to $56 range cited by the same source, alongside a separate note that CIBC raised its price target to 77 Canadian dollars around the same period, illustrating the kind of analyst disagreement that is normal and expected for any actively covered stock. The honest risk to watch: Enbridge carries debt levels described in one recent analysis as near the upper end of the company's own target range after more than $13 billion in new debt issuance, and the company's growth has relied partly on continued equity issuance and acquisitions. Both factors a careful dividend investor should track over time, alongside interest rate sensitivity common to capital-intensive infrastructure businesses. Stock number 3. Fortis Inc. What it is: Fortis is a Canada-based regulated electric and gas utility holding company with operations across Canada, the United States, and the Caribbean, generating predictable cash flows from rate-regulated infrastructure. The current dividend picture, as of mid-June 2026. Fortis's dividend yield is reported at approximately 3.2% to 3.3% across sources dated in early to mid-June 2026, paying a quarterly dividend of 64 cents per share. Dividend growth track record. Fortis's dividend has increased by an average of approximately 6.5% per year over the past 10 years, according to one source, with a 5-year average dividends per share growth rate cited at 4.85% by another. And Fortis itself has long publicized one of the longest consecutive dividend increase streaks of any major Canadian company in its own historical investor materials. Important flag for the final edit. One data source in this research cited only 6 years of consecutive increases, which conflicts with Fortis's own widely publicized long-term track record. This specific discrepancy must be resolved by checking Fortis's own current investor relations page directly before stating an exact consecutive year figure on screen, rather than guessing between the conflicting sources found in this research pass. Payout ratio and sustainability. Fortis's payout ratio is reported at approximately 73% to 74% of earnings, described by one source as comfortable. Though the same source also notes Fortis has not been generating positive free cash flow recently, meaning some of its dividend and growth capital spending has been funded through debt or reserves rather than free cash flow alone. A normal common financing pattern for regulated utilities undertaking large infrastructure build-outs, but worth understanding rather than ignoring. Capital appreciation and forward growth. Fortis has guided to a 5-year capital expenditure plan of approximately $22.3 billion through fiscal 2027, supporting a targeted rate-base growth of 6.2% compounded annually. A roadmap the company has explicitly tied to continued predictable earnings and dividend growth, reflecting the typical utility playbook of steady, regulated capital deployment rather than dramatic swings. The honest risk to watch: utility valuations and share prices are meaningfully sensitive to interest rate movements, covered in this channel's dedicated video on Vanguard recession-resistant ETFs and REIT interest rate sensitivity. And Fortis's reliance on continued debt and equity financing to fund its capital plan means rising borrowing costs can directly pressure both earnings growth and dividend growth pace. Stock number 4. Canadian National Railway. What it is, CN operates an extensive rail network spanning Canada and the United States, connecting 3 coastlines with access linking customers to all Class I North American railroads. Widely described in financial media as carrying a wide economic moat, given the practical impossibility of building a competing rail network. The current dividend picture, as of mid-June 2026. CN's dividend yield is the lowest on this list, reported at approximately 2.3% to 2.5% across sources, paying a quarterly dividend with an annualized rate of $3.66 per share. After the company's board approved a 3% dividend increase for 2026, announced January 30th, 2026, alongside a new share buyback program permitting repurchase of up to 24 million common shares, approximately 3.9% of shares outstanding, over the following 12 months. Why this is the clearest capital appreciation case on this list. CN's lower current yield is precisely the point worth understanding through a total return lens rather than a yield-only lens. A company returning capital to shareholders through both a growing dividend and an active share buyback program, which mechanically increases each remaining shareholder's percentage ownership of the company over time, and supports earnings per share growth, even if total net income stays flat, is prioritizing total shareholder return through a combination of income and capital appreciation, rather than maximizing the current cash yield alone. CN's own CFO explicitly described the dual approach in the company's own announcement, framing both the dividend increase and the buyback as reflecting strong cash flow and a disciplined approach to managing capital. Capital appreciation context from this channel's other research. Separate Morningstar coverage in early 2026 noted CN shares climbing 16.86% in a single month, February 2026, alongside a 6.78% gain over the trailing 12 months at that time, with the stock trading at a modest premium to one analyst's fair value estimate and assigned a 3-star out of 5 rating by that specific source. A reminder that even a well-regarded company's shares can trade above, at, or below a given analyst's specific fair value estimate at any moment, and that one analyst's rating is one opinion, not a consensus guarantee. The honest risk to watch. Rail volumes are tied closely to broader economic activity, industrial production, agricultural shipments, trade volumes, making CN's earnings somewhat more cyclical than a regulated utilities, and the company's ongoing involvement in cross-border merger and regulatory matters in the broader North American rail industry, referenced in CN's own public statements regarding other companies' merger applications, is a sector dynamic worth monitoring, though it does not directly affect CN's own current dividend. Stock number 5, Canadian Natural Resources. What it is, Canadian Natural Resources is a senior crude oil and natural gas production company with continuing operations centered in Western Canada, the UK portion of the North Sea, and offshore Africa, built around what the company describes as a diverse, long-life, low-decline reserve and asset base. The current dividend picture as of mid-June 2026, CNQ's dividend yield is reported in a range across sources of approximately 3.4% to 4.1% as of mid-June 2026. Macro Trends cites 3.95% as of June 18th. Digrin cites a forward yield of 4.05% as of June 16th, and one other source cites a trailing 3.41%, a useful real-world reminder, consistent with what we saw on RY earlier in this video, that even well-tracked yields vary slightly depending on the exact source and whether a trailing or forward dividend figure is used. CNQ pays quarterly, with its most recent quarterly dividend at $0.625 per share, following a 6.4% increase approved in March 2026. Dividend growth track record, the standout number on this entire list. CNQ's own investor relations release states that 2026 marks the company's 26th consecutive year of dividend increases, with a compound annual growth rate of 20% over that span. A shorter streak than Enbridge's 31 years, this is the company's own stated figure, repeated consistently across its March 5, 2026 and May 7, 2026 dividend announcement releases. Payout ratio. CNQ's payout ratio is reported at approximately 45.5% to 51% depending on the source, with one analysis specifically describing it as comfortable, a meaningfully more conservative payout level than either Enbridge's net income-based ratio or the company's own cash payout ratio, cited at approximately 81% by one source, the equivalent of Enbridge's distributable cash flow style measure, suggesting real, sustainable headroom for the dividend at current production and commodity price levels. Capital appreciation and the honest Q1 2026 wrinkle. One source notes CNQ's stock price rose approximately 6% following a strong earnings report and positive outlook, with a price target of 74 Canadian dollars from one analyst, Scotiabank, and a separate estimate of $59.95 from another source. But the same research also surfaced a less flattering data point, worth including honestly rather than cherry-picking only the favorable numbers. Q1 2026 results showed earnings per share of 65 Canadian cents, down from $1 and 17 cents in Q1 2025, with net income down 45% year-over-year to 1.35 billion Canadian dollars, and earnings per share missing analyst estimates by 41%, even as revenue of 10.8 billion Canadian dollars exceeded analyst estimates by 6.3%. This is a useful, real example of a stock where the dividend story and the most recent single-quarter earnings story are genuinely mixed rather than uniformly positive. The honest risk to watch: as an oil and natural gas producer, CNQ's earnings are directly exposed to commodity price volatility in a way none of the other four names on this list are. The Q1 2026 earnings decline above illustrates this directly, and the company's own stated dividend growth, while historically strong, depends on sustained oil and gas prices and production levels that are inherently more cyclical and externally driven than a bank's net interest margin, a regulated utilities rate base, or a railway's freight volumes. The best dividend stock isn't automatically the one with the highest yield, the longest dividend streak, or even the strongest recent performance. It's the one whose combination of yield, dividend growth, payout ratio, business quality, and long-term total return aligns with your own investing goals. Royal Bank, Enbridge, Fortis, Canadian National Railway, and Canadian Natural Resources each bring a different mix of income, growth, and risk to the table, which is why understanding the business behind the dividend matters far more than simply chasing the biggest percentage. If this video helped you think about dividend investing through a total return lens rather than a yield-only lens, then you've already taken a step most investors never do. And remember, before buying any dividend stock, always verify the latest numbers yourself, because the best investors don't blindly follow recommendations. They understand exactly what they own and why they own it.